Why do I need life insurance? For many, life insurance never crosses our mind until we or someone we know go through a life-changing event. It's not until some important event in our lives takes place, such as getting married, buying a house, or having kids, that we start thinking more about our obligations, responsibilities, and priorities. Although we are all going to die, what we don't know is when. Life insurance is a tool to help people prepare for the unexpected. Unfortunately, for many Canadians, confusion exists about why they need life insurance, and today only 43% of Canadians own an individual life insurance policy. A recent industry survey highlighted the top 2 reasons why Canadians delayed buying life insurance. Most felt it was a low priority for them, or they thought that life insurance was not affordable. Deferring the purchase of life insurance can be the easier decision for individuals. However, the longer you procrastinate, the harder it may be to get coverage. Costs or premiums may be higher, and there's always the risk that the unexpected happens and your family doesn't have the income protection when they need it. Yet life insurance is very affordable and is an important part of a personal financial plan. In fact, for the price of a daily cup of coffee, the typical Canadian mom with a young family could cover the amount of the average Canadian mortgage on a new home. The following are typical life events that can lead to people considering the purchase of life insurance. 1. Getting married. When you get married, you share each other's financial obligations. Would your spouse have enough money to keep their current standard of living, cover your funeral costs, and pay off any debt and taxes? 2. Buying a home. Could your family cover the mortgage payments and all of the associated household maintenance costs if you died too soon? 3. Starting a family. If something happens to you, would your children have all of the opportunities you dreamed of? Would there be enough money for daycare or tuition for college or university? 4. Starting a business. Would your business survive if you or a business partner passed away? If you find yourself entering one of these exciting events in life, speak to an advisor who can explain the benefits of life insurance for protecting your income in the future and providing for your loved ones should the unexpected occur.
This is an average, hardworking person just like you. And if you are anything like 50% of America's households, you don't have enough life insurance. Oh, sure, you're not worried. You're young, healthy. So why do you need it? Having the right amount of life insurance can help you fulfill your promises to the people you care about at a time when they need it most. And also, it can be an important way to help protect against the unexpected and help prepare for the future. When you're ready to get life insurance, you'll have 2 basic types to choose from: term and permanent. The difference is similar to the difference between renting and owning a home. Term is a lot like renting. Just like a rental, term life insurance is temporary, providing coverage only for a certain amount of time. Term is known for its affordability, and since it's initially less expensive than permanent insurance, it is a good start to getting the protection your family needs. Depending on your policy, you may also convert term insurance to permanent insurance later on. So make sure to pick the right policy and a company you can trust. Permanent insurance is more like owning a home. Like a home builds equity, permanent insurance can build cash value over time, and you're covered no matter how long you live. Plus, you can use that value throughout your life. Whether that's for starting a new business or college costs. Many people who buy term life insurance convert to permanent life insurance or combine the 2 to get that long-term security for their financial plan. There's more to learn about life insurance. Find out the right amount of coverage and the types of insurance your family needs by talking to a MassMutual financial professional today, or visit massmutual.com/li.
Hi, it's Carl Ostenson with the Ostenson Insurance Group, and thanks for watching the video. Today we're going to talk about life insurance, but not just as life insurance. We're also going to look at it as a superior investment. Now, what's a problem that people have with life insurance? Well, you could also call it death insurance, because typically someone has to die in order for anyone to get any benefit out of the policy, and that's not real fun to think about. So what if there was a policy that gave you some benefits while you were still living? What if a policy could accumulate money tax-free and then enable you to access that money tax-free? and then blossom in value and transfer money tax-free to your loved ones when you died. Would that be of any interest to you? Well, here's an example. Let's look at a 40-year-old male with a wife and 2 children, and he wants some life insurance for his family, and he also wants to grow a nest egg for retirement. He wants retirement income at age 65, and he also wants access to money in case he ever has severe health problems down the road. Well, he can get all this in one policy. And this type of policy is called an indexed universal life with living benefits, and it's the new breed of life insurance. The key is having a policy that builds up cash value. And the engine that builds up cash value in this type of policy is called indexing. It works like a hybrid between investing in the stock market and having the safety of a fixed account. And typically there's 3 types of policies that build up cash value. Variable life, that's the red line. You invest your cash value in the stock market and mutual funds. There's upside potential, but your money is at risk. And whole life, the light blue line, that keeps it safe, but sometimes the growth potential isn't very high. Now there's nothing wrong with either one of those. They are what they are. But indexing combines the two. You get the upside potential of the market with the safety of a fixed account. In years the market goes up, you share in the gains and you lock your gains in. But in years it goes down, you don't lose anything. And by doing this type of policy I'm showing you would have a 25-year average return of 8.6% because it does not lose when the market goes down. But we're going to be even more conservative than that and use 8% for our illustration. So here's an illustration of our 40-year-old male. And after finding out about the growth potential and the tax advantages of investment-grade life insurance, he decided to put away $10,000 a year into a properly structured investment-grade life insurance contract. And on the left-hand side, you can see his $10,000 premium every year from age 40 until he retires at age 65. Then there are no more premiums. From day one, he gets a $706,000 life insurance policy to protect his family. If something were to happen to him, his wife and children would get $706,000 tax-free to help them stay in their home, buy groceries, and pay for other expenses. Now he also gets a cash value growth account, and this grows tax-free. At our assumed rate, at the age of 65, he would have accumulated over $522,000 in his cash value account. And no taxes were paid on that growth, and his money was safe from losses. And this $522,000, it's his to do what he wants with. He can take it out for whatever reason he wants. It's his money. And alongside that, you see that he still has life insurance too. It's still a $706,000 life insurance policy. So now at age 65, he retires, and he says, I need some money. So he decides he wants one big check, and he wants out all the money that he put in. So he takes out $250,000, and that comes out tax-free. And then in the years after that, he needs income too. So this policy would also provide him with $34,000 in income every year until age 99. And that income is tax-free as well. And the life insurance stays in force. Now the numbers will drop as he withdraws money on the life insurance, but there is still life insurance protection for his family. So recapping that, it's one policy. He has a cash value account worth $522,000 at age 65. He still has $700,000 in life insurance. He takes out one big lump sum check of $250,000 tax-free, and he gets $34,000 a year in tax-free retirement income until the age of 99. So then let's say he dies at age 99. Well, over the years, he would have received over $1.3 million in tax-free income. And there's still a $238,000 life insurance policy that passes to his family. No, this isn't too good to be true. This is properly funded investment-grade life insurance starting as young as possible and giving it time to grow for you. So it provides tax advantages for retirement. It provides life insurance for your family. But what happens if you get sick? Well, these types of policies also have living benefits. They allow you to accelerate the death benefit, and you get to use it while you're still alive if you get a terminal illness, or if you need long-term care, if you have Alzheimer's or a heart attack or a stroke. In our example, he could get over $500,000 tax-free to live out his life or pay bills if he gets diagnosed with a terminal illness. At age 65, if he gets Alzheimer's or needs long-term care, he could get up to $10,450 per month for 5 years to pay for it. And if he has a heart attack or some other kind of critical illness at age 65, there's $522,000 tax-free to help out. So there's three things that happen in life. We live, we die, and we may get sick. And this type of policy can cover all those things. So compared to IRAs or 401ks, real estate or bank CDs, this type of investment-grade life insurance has some benefits that those things do not. It's unique because no other type of investment will give you all of these things in one package. So to review, you can purchase one of these policies at age 20, 30, 40, 50, or 60. The younger, the better. And in the case of our gentleman who was 40 years old, with a wife and 2 children, he had tax-free money for his family in case he died. There was tax-free growth of a nest egg for his retirement. Then there was tax-free retirement income, and then tax-free money for severe health problems. And he got all of this in one policy. So I'd be happy to provide you with more details and an illustration so you can see some numbers for yourself. If you'd like to give me a call, again, my name's Carl Ostenson, and you can call me at 847-376-8400, and I'd be happy to help.